Hey everybody, Marty Missouri here, January 20th, 2024 with your weekly economic update. Going to do the usual, look at a few inputs to our index. I am going to spend a little bit of time, I will keep it quick, on the stock market, being that the S&P and I believe the NASDAQ as well peaked their noses or their heads into all-time highs on Friday. Want to kind of look at that from a technical perspective and also look at it from another angle that I think you'll find interesting as well. So first things first though, made back what we gave up last week, 4-point improvement in our index. And I want to point out here that from a technical analysis perspective, these are higher lows that we're seeing in here. So this would suggest that overall economic conditions are improving, still in the territory that says recession odds are too high to ignore. But nevertheless, we are seeing some trend improvement that we will want to continue to acknowledge and keep our eye on, so to speak. Okay, so let's just jump into a few things here. I showed a couple of our inputs on the video that I sent to clients on Friday that I recorded on Thursday night, so I think I'm skipping those. Housing starts came out this week. You can see they ticked down just a little bit here. Single family housing really took the hit as opposed to multifamily. Permits tend to lead housing, so we got a slight uptick in overall permits in terms of single family permits. Yes, a slight uptick there as well. So that would suggest a slight uptick in starts this next month. Big, massive move upward in the University of Michigan Consumer Sentiment Survey. It was good virtually across the board, although the parting commentary was still concerning in the survey as the survey was presented. But inflation expectations came down, employment expectations came up. In fact, I'll borrow from Peter Bookvar's analysis here. The University of Michigan Consumer Confidence Index jumped to 78.8 from 69.7. That was well better than the estimate of 70.1, with both the current conditions and expectations components higher month on month. It's also the best since July of 2021. One-year inflation expectations fell to 2.9% from 3.1, and the five-year guess slipped to 2.8 from 2.9, helped by lower expectations for gasoline prices. Employment and income expectations improved, and there was a rise in the mean percent of those who expect their family income to exceed inflation over the coming 5 years. That is confident. The confidence rise, mostly because of lower price expectations, helped to lift spending intentions for a vehicle, home, and major appliance. Bottom line, consumer views were supported by confidence that inflation has turned a corner and strengthening income expectations. This is actually from the University of Michigan itself. This is their commentary. Like December, there was a broad consensus of improved sentiment across age, income, education, and geography. But then there are the caveats. Consumers are hardly sanguine about the economy. Consumers are split in their expectations of business conditions over the next year. 41% expect good times, or 41%, while 48% expect bad times. High prices continue to weigh on consumers. About 37% blame them for eroding their living standards. Little changed from a year ago, despite a substantial slowdown in actual inflation during this time period. So, a lot of good stuff, but clearly, with the parting commentary there, not all good stuff. I want to pull up another panel we have on this chart, and that is just an observation of mine, and that is consumer sentiment. Clearly, in my view, and I've watched this for years and years, tends to be very correlated, frankly, with the stock market. So as the market goes up and people's 401ks go up and animal spirits go up, that tends to boost consumer confidence. And we had a really strong end to 2023, and you can just chart this right along, right? Market goes down, sentiment's going down, and so forth. So definitely a noticeable correlation, right, between stocks and how the consumers feel about their conditions. Home builder confidence index, or the housing index, it's not nearly great, because above 50 would be home builders saying that we're growing, we're expanding, but it's an improvement. They are giving a lot of incentives to make those sales. Mortgage rates have backed off a little bit, and then buyer traffic is still abysmally low at 29, but a little better than the previous month. Initial jobless claims continue to plummet. 187 is historically very low. I mean, this isn't even adjusted for population, right? And look at how low that is. I mean, that's lower, and this goes back to the early 1970s, right? Now, I've made the case that it's not the level, it's the trajectory. Still a higher low, which isn't great, and as I pointed out a zillion times, it's like once it starts, from whatever level, recession seems to start as well. So are there leading indicators that can give us a feel for what's going to happen? Well, one would be this blue line up here, which is the job openings number, right? So when job openings begin to roll over, unemployment claims begin to show up, right? You can see it beginning to roll over here. You can see trend beginning to change there, and we've been rolling over a ton here of late, so that comports with our concerns about the economy, say second half of the year. Commercial and industrial loans picked up a tick for us here, as you can see, back into positive territory. Very noisy number. It's not unusual to have it tick up going into recessions, but it is a positive to us right here. And then I think last one here, just in terms of our inputs, I do want to point out that while it's rolled over a little bit here, we have seen a pretty notable improvement in terms of consumer staples versus consumer discretionary. They're both down on the year. This is just that staples are 2% better. So that's something we haven't seen in a long time. And again, that tends to be consistent with a weakening economy when consumer staples, the things people gotta buy, outperform consumer discretionary, the things people buy when they're feeling really good about their financial circumstances. Okay, so I wanted to get to the market, and I'm going to borrow from a gentleman who I believe is retired from the financial industry, and he points to this chart, which I think is very interesting. First of all, let me just actually pull this back and show you the yield curve. So we've explored this in a lot of detail over the years, and I've explained kind of how it works and what causes an inversion and what causes it to steepen or re-steepen, if you will. It's one of those indicators that you can, that people count on to give them a signal that recession risk is high. Now, it can be quite the lag between when the reversion happens and when the recession hits, but it tends to always hit. But notice that we tend to re-steepen leading into recession, right, on the 2-year, 10-year spread, and you can see what's happening here. Now, the Fed apparently focuses on the 3-month 10-year, and you can see you're getting a little re-steepening here. It got real threatening right in there. So this gentleman went back and pointed out the times when, like yesterday, the market peaked into a new all-time high amid a time while the yield curve is inverted or still inverted, right? So the arrows show when it inverted, and then you can see the all-time high, in this case, I don't know, a year later or so, right? And then you can see that this was corrected a bit. It was the early 90s before we were off to the races. We had an inverted yield curve virtually when the market hit the all-time high in the late 90s. Of course, that was a 50% decline for the S&P and an 80% decline for the NASDAQ 100. And then remember, folks, we got just right back to the peak, and the yield curve was inverted for quite some time before the peak in 2008, and that 60% decline for the S&P 500. Here we were inverting during that time when the Fed said everything was okay. Our indicator was saying recession is likely coming, and you could see that the yield curve inverted. It's not unusual for the market to take off because the Fed is now freaking out and printing money, yada yada. 35+% decline depending on the index. But then all that money printing came in. Bottom line is we've had this inverted yield curve for quite some time, and the market's hitting all-time highs. I'm not saying that it means that this is going to happen. That is still our base case, that the risk is too high of that to pretend it's not there, so to speak. This is interesting, though, in that it gives you an historical look at what happens when we get to these new all-time highs amid an inverted yield curve, or what has happened historically. Now, quickly, as I promised, I want to just update the daily charts because here we are, right? New all-time high. So this is your 5-year S&P 500 chart. We're just extending that bearish rising wedge amid negative divergences here, and a long one, which is the wrong kind here on the MACD. And folks, where were we at the previous all-time high? Right here. Okay. And right here with the divergences. Technically, this is a really bad look. Okay, but we could burn through these divergences. We're getting closer. Scream higher. Something great happens, and I will tell you when the technicals tell us that it's safe to go swimming, so to speak. And again, this is virtually opposite. Remember how bullish we were right in here on a short-term basis. The macro said stay cautious, but we were telling you that such a high likelihood here of a bounce, and we were telling you that right in here as well. So here we sit today with the opposite look of a bullish chart and the same look of what we had the last time the market topped the NASDAQ 100 index. Here we are with our rising wedge. Here we were with a rising wedge, right? Here we came off of that. We did not peak into all-time highs here. We did here. Maybe that means something. I guarantee you there's a lot of Wall Street bulls who are saying, folks, we did it. New bull market, off to the races. I'm going to say, folks, not so fast. Maybe they're right. I'm very open to that. I will love to tell you that we were, quote, wrong, but we're not making something that would be a right or wrong, judgment. We're saying conditions and the technicals say be very, very careful right here. You have, the kind of look that I've shown you over and over and over again historically can lead to trouble. Russell 2000, notice, by the way, folks, I've shown you, those all-time highs. We are not even close to an all-time high on the Russell, and nor are we on the S&P equal weight index, which is the same stocks as the S&P, but it's just not the Magnificent Seven that are fueling it. It's got still a good gap between its all-time high. So I ghosted what would be left of this bear flag here so that I could show you that we did bounce. Remember I said we had this level here that we were holding, could be a bounce level, bounced right off of that, and you had double support with the 50-day moving average. Now, I believe for much of the day, and you can see the bottom end of this candle, if you can see that last little candle there, we were actually down while everything else was up, but it did catch itself here, and that's not a bearish candle. So maybe we'll get some life out of the Russell 2000. I'm not counting on anything right here. Again, from more of a big picture, call it macro view if you like, we need to be very cognizant of the fact that one of the most reliable recession indicators, the inverted yield curve, it's not unusual at all to see a market hit an all-time high amid yield curve inversion. But the outcome here over decades has been painful in every instance so far, and this may be the outlier. Got to stay open to all possibilities. Folks, thank you as always for watching and listening. Hope you all have a great weekend. I'll talk at you next week. Take care. Bye-bye.